I recently had a chat with a fashion designer. Let's call her Maggie. She worked with a financial advisor on her investment portfolio, and within 3 years, her portfolio lost 2% in value. This was during a time that the global stock market actually flourished. We had a chat about this portfolio, and I asked her why she hasn't considered taking control of her investments herself and just start making her own stock market investments. Her answer: she doesn't understand finance well, she is not a math expert, and she just feels completely overwhelmed by the stock market. What I actually want to do in this video is break it down into more basic terms, but also use my wonderful whiteboard and handwriting to show you just some basic concepts behind index investing, and also why it's actually not that complicated to manage your own investment portfolio. You will understand why index investing is the superior way of investing, and most importantly, you won't be overwhelmed or intimidated by some of the terms or the concepts anymore. If you're completely new to investing and you haven't invested in the stock market, or you're unsure of how to get started, I've got a free 5-day mini course that you can take. It's linked in the comments, so you can sign up to that, and you can always come back to this video once you understand a bit more. But if you've never heard of index investing, you're not alone. A lot of people that I talk to have no idea about index investing. But this is clearly the superior way of investing. Have a look at this chart, which shows us a very clear trend of the amount of money that is flowing out of actively managed funds into passive index funds. So what is a passive index fund? We have to start with an index first. An index is really just a list that's compiled and serves a certain purpose. For example, a list that tracks the US stock market, which is the purpose of the S&P 500. It is dynamic, it resets quarterly, and there are different indices that achieve different purposes, like an index that tracks the global stock market. If we, for example, have all of these different companies that are listed in the US. Let's say all of these dots represent the different companies in the US. Some of them are much larger than others. The size represents their market cap, which is basically the value of the shares in the company. So if we had to try and invest in this total stock market in the US, for example, then because some of these companies would be so much larger in value than others, we could just say, in the case of the US, we're going to just pick out the 500 largest companies, which in this case would be an S&P 500 ETF, and we're going to invest in those. Every quarter, if anything changes, as in if this large company, let's say this is Amazon, if this large company shrinks in value, then the value that is allocated in the ratio of your ETF towards this certain company would also decrease. So it is dynamic in that way. You don't have to sell or buy and worry about should I be including or excluding this company, because what you're trying to achieve here is actually just including the 500 biggest companies in the US in your portfolio, and in this way get exposure to more than 80% of the US stock market. So yes, of course, there are other small companies, which we would call small cap companies, and they're not included in the S&P 500. So you could, for example, look for a small cap ETF if you also wanted to cover that part of the stock market. But there is also a stock market beyond the US stock market. An MSCI All Country World Index, for example, it would give you mainly exposure to the US, but also include other developed markets and emerging markets. So this is a really great way to get diversification. But what's amazing about this concept of index investing is that it allows you to buy an entire haystack instead of looking for the needle in the haystack, which is the way that Jack Bogle describes index investing. He says that you would be a much smarter investor by just buying the haystack instead of trying to pick the needle in the haystack, because by buying the haystack, you're guaranteed to have the needle included. Instead of trying to pick the highest performing stocks, which is really, really hard, you can just be a smart investor and you can just buy the haystack and include automatically the best performing stocks this way. We've got a lot of data that helps us with this, and it's actually quite empowering because you'll be able to know by the end of this video that you are better off just tracking the average of the market instead of giving your money to someone else that is actively trying to outperform the market. And I have like a very basic image that I want to draw on that, because I think this concept will hopefully help you understand why it's so hard to beat the market. So if we just plot on this chart Here is the highest returning stocks and the lowest returning stocks. So when I talk about return, in this case, I just talk about total return. So we talk about the growth component and the dividend component of the stock's return. So if we're just plotting all of them here are all of the potential stocks. Let's just say, for example, this is our population. In essence, what an active manager is trying to do is to say that by their proper research and analysis, they are able to select the top performance on this chart. What you might be thinking is, okay, if they select these top performers, then I'm going to be stuck with these bottom half performers, which is actually absolutely not the case. Because first of all, if all of the great analysts and asset managers out there are after the top performers, then this is going to push up the price, because then the demand for these top performers are going to be higher, and that's automatically going to push up the price, because there is a demand and supply dynamics in the stock market which influences price. And if everyone is going to be moving away from the low performers, then of course this is going to make them much cheaper. And the problem with this is, of course, if you pay too high price for a stock, then the expected return or if the stock is overvalued, then the expected return is going to be lower. So ultimately, if everyone is chasing the same outperformers, then they're not going to be able to achieve outperformance. And the other very important thing to note, of course, is that it's so difficult to know before the fact which of these stocks are going to be the high performer stocks versus the low performing stocks. And now with 20 years of data, we can know that it's so hard for active managers. I'm actually going to show you a few charts on that, but it's so hard for active managers to be able to carefully select the top ones. And more than 90% of the time, you are better off just covering the index or just tracking the average of the market, which includes all of the stocks, because then you will automatically have the best performers included in your portfolio. You might be wondering why everyone isn't selling you index funds. So why is this not a product that you have included in your investment portfolio, or why people aren't knocking on your door to tell you about index funds and trying to convince you to invest in them? There is a lot of information on investing out there on the internet. And if you can read up and look at some of the most respected financial authors like Morgan Housel or Nick McGuiley, I actually have their books here. Here are actually 3 books that I just got behind me. And all 3 of these talk about index investing and how they manage their own money and how they invest in index funds. So first of all, index investing is superior, especially for you as an investor, because the fees are low. Because there is no high fees involved in order to have an office, analyst, portfolio managers, and office staff to be able to manage active investment funds. That's not needed for index funds, because it takes a lean team to run these index funds. And because of that, the fees are much lower, first of all, but also because it's a volume game. Because these funds have become so popular, Vanguard have actually continuously decreased their fees. As their funds grow and index funds become more popular, they've actually been able to decrease their fees. The obvious point is, because there is not a lot of fees to be made, obviously people are not going to sell you index funds. A salesman or woman needs an incentive to sell you something. And if there is no incentive, then unfortunately it's not going to be sold. The second thing is, when you work with a financial advisor that's linked to a certain investment house, then they are only allowed to sell funds from that investment house. And a lot of investment houses make their money from actively managed funds. So they don't even offer index funds on their menu. So when these advisors come to you, they're only allowed to sell the products that they have on their menu, of course. And because high fee funds make a lot of money for investment houses, there are a lot of advisors out there that don't even have this product on offer. The third and incorrect thing I've heard is that active management is needed in volatile markets. There is a lot of data now, and I'll also share that a bit later, that this is not the case. Actively managed funds are not needed during volatile times, and they also don't outperform during volatility. And lastly, if you're asking them, why am I not invested in index funds? I mean, I would find their reasoning interesting, but if they're saying that either they're going to say it's needed during volatility to protect your portfolio from volatility, or they might say that their funds are superior, I would really encourage you to actually dig in and look at the returns that is generated compared to just an index fund over that period, a global index fund, I must add. Of course, they need to protect their territory, and they definitely don't want to admit, perhaps, that they have been investing you in not the best investment products for you. Anyway, this is just another reason that I would encourage you to read more on this, to do more research, and to take responsibility for this yourself. Okay, so these SPIVA scorecards I find really interesting because for some reason, not many people know about them, but they're actually a great way to look at the data and prove to you why passive or index investing is the superior way of investing. Because have a look at the US scorecard. So this is basically a list of indices, and they look at how many funds, a percentage of funds in the US in this case, underperforms their benchmark. And notice the longer the timeline, the higher the rate of underperformance. And this is interesting because a lot of actively managed funds might have good years, and it's usually in those years that they attract a lot of money because they might have a good year and all the investors might think, oh, they've got the inside knowledge or they've got the secret sauce. Then they might attract more money. In the shorter term, some active funds are lucky, and over a 3 or 5 year period, they might outperform the market. But as soon as we go to a 10, 15 or 20 year timeline, notice the 20 year column, then less than 10% of the funds are actually able to outperform the market. And the really hard part is to tell which funds are going to fall part of this 10% before the fact. Because when a fund comes to you and they say they've had 1 good year or 2 or 3 good years and they've outperformed in those 3 years, then it definitely doesn't necessarily mean that they are going to be one of the funds that actually make it in the top 10% funds over a 20-year timeline. So is it even worth the risk to try and pick a fund and then hope they're going to fall within the 10%? Here's another interesting table of funds in South Africa that try to beat the global equity index. I think this one is actually insane because over a 10-year period, there is 100% underperformance of these funds on the global equity index. That means if you have been investing in a fund in South Africa that is trying to beat this global equity index, there is a 0% chance that you have outperformed this index. Because according to this data, it actually 100% of the time, these funds have underperformed that index. And this becomes quite serious because of the underperformance and the fees that you pay. It can really be quite devastating. If you're still watching, you're probably serious about learning more. I've got a free masterclass that you can watch that shares my exact framework of how I think about investing, and I share some tips with you on how you can get it right. You can comment free on this video and I'll share the link with you. So let's talk about underperformance, because a lot of the time and in a lot of my videos, I talk about fees, and I always warn you against fees because yes, it does have a devastating impact on your portfolio in the long term if you pay high fees. But what's even worse is investing in actively managed funds that underperform the market, because that could mean losing out on 2, 3, or even 4% of returns per year. Have a look at this screenshot, which is a highly regarded fund, I would say. And the since inception returns, this is in US dollar, by the way, has been 7.3%. It also shows the MSCI World Net Return Index, which is the benchmark in this case, and which, of course, you can actually just invest in by investing in an ETF that tracks this index, by the way. The index has returned, also since inception, 11.9%. This is quite a scary difference of 4.6%. That means the since inception returns that you would have lost out on per year of being invested in this fund is 4.6%. So this fund specifically have top analysts. They have the best staff with most experience. They've got portfolio managers. They've got very fancy offices, and they all wear very nice suits. But despite that, they underperformed with almost 5% per year. As an investor, this could literally cost you millions. What is this difference attributable to? In this case, this fund has a total investment charge or a fee of 1.42%. So the difference or the rest of that underperformance is attributable to poor investment selection. That's more than 3% per year lost out on due to poor investment selection. If we had to assume that this underperformance would continue for the next 30 years, what could that look like for you as an investor? Over a 30-year period, let's assume this underperformance continues for the next 30 years and you invest $1,000 a month, then you would actually miss out on half of the potential returns that you could have gotten if you had just invested in a low-cost MSCI World ETF. And for $1,000 a month invested at these returns, that could mean the difference between 2.4 million and 1.2 million. So where does the secret lie in being a smart investor? It doesn't lie in selecting smart funds or being convinced by someone that comes to you in a very fancy suit and an expensive car to try and sell you investment products. It really lies in being consistent, committing a monthly amount that goes into your investment portfolio, keeping your fees low, and investing in low-cost index ETFs, not being deterred by stock market volatility, because if you're only investing when the stock market is up, you're definitely not going to get the kind of returns that you should. And also, getting the psychology behind money right. If you're overspending money and you're not investing enough, you're going to have a much better impact on your investment portfolio by getting your spending under control and actually investing and committing to investing a set amount of your income if it fluctuates every month, rather than trying to select the best funds or trying to stock pick yourself even. I hope this video was useful to you. Please let me know in the comments what else you would like to learn and what else I can make a video on.